So welcome everyone to our webinar for today, where we will be talking about transfer pricing in China, Hong Kong, and Asia. And today is a very special webinar for our firm and also for our collaborated firm for today, which is going to give some very interesting insights on China and Hong Kong perspective. So this webinar has been organized by Transfer Pricing Solutions Asia and Chen & Chen Limited Certified Public Accountants. So before we deep dive into the webinar for today, we will do a 1-minute introduction so you know who is speaking today. First, I want to pass the baton to Mr. Henry Kwong, who is the partner of Chen & Chen Taxation Services. Henry, please introduce yourself.
Thank you. Hello, everyone. I'm Henry. So, I'm the tax partner of Chen & Chen. We are a CPA firm in Hong Kong and China with over 250 staff. So basically, of course, taxation is one of our special areas that we can provide China, Hong Kong, international taxation, of course, as well as transfer pricing. Of course, we do other work as well. We offer audit service to some specialized industry as well as the listed entities in Hong Kong as well. So thank you. So it's very great honors to have the chance to share the transfer pricing updates to you. As I'm, of course, some of you may know that I'm also one of the speakers in many public organizations in Hong Kong. Next.
Yes.
Next, so just to, I think many of you have already got our content. Just to let you know that we still have our monthly updates. I suppose you have, some of you have received them a couple of days ago. So we will issue monthly publication to our clients every month to update on the Hong Kong and China taxation. Just to give you a few background of my background as well as my firm. So I think I've done enough introduction. So how about you, Gina?
Thank you, Henry. So from our firm, we have two presenters today. First, we have Hon Chuan Tan, which is our director in Malaysia, with over 10 years of experience in managing and helping multinational groups in transfer pricing advisory and helping them to basically stay out of trouble with the tax authorities, and at the same time giving them strategies to optimize their tax and transfer pricing. He prior to joining our firm, he helped developing one of the biggest mid-tier firm transfer pricing practice in Malaysia. And I will be the second speaker for our firm, which my name is Adriana Calderon. I'm the director and lead partner for our Asia office. I'm the co-founder of both Transfer Pricing Solutions Asia and Malaysia, with more than 15 years of experience in advising multinational groups in areas of tax, international tax, and over the past 15 years in transfer pricing. Apart from that, we as a firm are very passionate to educate our clients and the industry. So I also teach in the Institute of Chartered Accountancy of Singapore and Singapore tax professionals. Just a brief overview about our firm. We specialize in transfer pricing advisory. We have 3 offices that cater to the Asia or the Southeast Asia market. Our head office located in Australia, our 2 expansions in Asia, our office in Singapore and Malaysia. And I think with that, let's just go into the detail. I'm sure everyone is eager to have some perspective from the experts. So we will be covering 3 topics for today. First, we're going to talk about the general transfer pricing environment in Asia. 2, we will be going through a case study where we are going to raise some of the typical questions that we heard from our clients, and we will give you a few tips that you can take away on how to manage certain issues. We will then talk about common areas of disputes, and more importantly, how to be ready to manage those disputes. So let us start with transfer pricing in Asia. So for those who are not too familiar with the general requirements, let us just summarize what are the key transfer pricing requirements in Asia from a compliance point of view. So there are two key aspects that are always required by taxpayers to submit or prepare together with the tax return. One is the tax return forms that are required to be submitted every year in every country. And since the evolved landscape of transfer pricing, we have that in most countries in Asia, we will have a tax form that is dedicated to disclose the related party transactions with values, countries that the party transact with, and in some countries it can be as complex as having to disclose the level of documentation and the transfer pricing methods. We also have that Asia has adopted fully the requirement of having to prepare TP documentation. And that TP documentation, depending on the size of your business, can be in the form of a master file, a local file, or a country by country reporting. So if you are a significant global entity with global revenues above around 1 billion, the chances are that you have to worry about the three types of disclosures and documentations. If you're below that threshold, the chances are that you have to worry about master file and local file. Another aspect to keep in mind is that in Asia, there is already a lot of implementation of the automatic exchange of information treaty, or the MLI, whereby tax authorities are allowed to exchange information even without the taxpayer knowing, which is why it's called automatic exchange of information. So in Asia, tax authorities take transfer pricing quite seriously, and they are actively making sure that taxpayers comply. So the second question is, what is the scope of transfer pricing in Asia in general? And with that, I'm happy to ask Hon Chuan Tan to give some insights and put some color into this question.
All right, thanks, Adriana. Well, I guess the first question is what is the scope of transfer pricing where we are at? Now, transfer pricing arises when there are transactions between controlled parties, meaning related parties, right? So the first step is actually to determine the existence of related entities first and foremost within the group by way of control, which can be direct or indirect. Now, the control can be based on your shareholding equities or management control, but sometimes bear in mind that there are certain jurisdictions where they explain further as to relationship between taxpayers. For example, you have your husband and wife, which actually may trigger the control definition. So it's very important for you to assess your local definitions to ensure whether you fall under the purview of the local TP rules in relation to control. And I also like to highlight that certain jurisdictions may apply their transfer pricing rules to domestic related party transactions in addition to your cross-border transactions. So please keep that in mind.
Thank you, Hon Chuan. And before we go any further, let me remind everyone that we will have a Q&A session at the end of the webinar. And during the Q&A, you can post your questions in the Q&A box that we have in the webinar, and we will be more than happy to help. Henry, so I know you're going to talk about Hong Kong and China in the following slides, but just if you could give us some overview on what is the scope in China and Hong Kong. Is it the same, that you have some domestic requirements, or is it just focused on cross-border?
Thank you. I think, of course, we have some, first of all, we have some domestic transaction exemption. So for certain domestic transactions, which means within the same jurisdiction, then there could be exemption from transfer pricing adjustment But at the same time, I will highlight in the following slides that because Hong Kong and China allow offering some tax incentives, which is it means a lower tax rate to some special industries. So even within the same jurisdiction, two entities may be paying different tax. In case they have the related party transactions between them, transfer pricing will be the focus of the Hong Kong and as well as the China tax authorities as well.
What about from your side, Hong Chuan, if you want to make a comment on Malaysia?
Yeah, I think similar to China, where Malaysia has domestic real party transactions in place. Similarly, there are exemptions where I think the rule of thumb is to ensure that for domestic transactions, the domestic entities, if they were to have the same effective tax rate, then they won't need to actually prepare the transfer pricing documentation.
Similar approach in Singapore as well, where domestic transfer pricing applies, but if it is different tax rates, you will the same tax rate, then you may have an exemption. So what is the general approach in Asia for transfer pricing? And I guess the question is always, is transfer pricing based on some worldwide guidance or not, or is it different in every country? Do the methods apply? I think this is probably one of the most common questions that we get. And I think what we have to keep in mind is that each country has their local transfer pricing guidance. Now, those guidance have been all based, we have gone actually through all of them in Asia, and they all are based in OECD principles, meaning that the type of methodologies and the essence of conducting a transfer pricing analysis doesn't necessarily change significantly. Having said that, there is a component of local view that is always valuable from basically understanding what is the expectation of the tax authority in the event of an audit. That is always very important, because there will be different interpretations and different local views, which we will talk about during the common disputes. So at the end of the day, all tax authorities in Asia are focusing on defending the tax revenue and preventing tax leakages. And I think that has been even more prominent after COVID, where obviously there is an interest on governments to collect their tax revenues and prevent leakages. In most countries, or I will say 100% of the countries now, you have to prepare documentation to support your disclosures in the tax return and to support your tax computation, especially if you have a lot of components in the tax computation that are associated with control transactions. So for example, high value deductions or high value of income that is related with control transactions. In some countries in Asia, we have that there is local language requirements where you have to translate your transfer pricing documentation in local language. And lastly, I think it's always good to keep in mind that in Asia, obviously, there is a focus on pricing the transaction, but also on the profit outcome that that price has, or what is the profit outcome impact on the taxpayer, mainly because the profit outcome is essentially the basis for your tax computation. So even though you usually transfer price is about testing a price, it's also about looking what is the impact on profit outcomes. I think a couple of extra points here, which is that TP documentation is probably the main document that helps taxpayers to protect themselves from compliance, non-compliance penalties and surcharges penalties as well. In most countries in Asia, we don't submit the TP documentation, but we have to have it ready by the time the tax return is lodged, which Hon Chuan Tan is going to talk about more about this. And generally, when an audit comes, you have a very small period of time to provide the documentation. In some countries, it's only 14 days. In others, it's 30 days, and it's very hard to ask for extensions. And obviously, from the tax authority point of view, it is reassuring to have taxpayers preparing documentation, mainly because it shows that the company has been thinking about complying with the arm's length principle and with the transfer pricing provisions. So then the next question is, if in most countries we have to prepare documentation, is there a common deadline? And with that, I'm going to pass it to Hon Chuan on this point. What is the general requirement, Hon Chuan?
Yeah, the timing for the preparation of TB documentation is actually very crucial to ensure that you comply with your local TP rules. The term here that we generally use is contemporaneous, where a TP documentation should be prepared when taxpayers are actually setting up a control transactions, which means before implementing your control transactions, you have to start the preparation process, and most importantly, to determine the arm's length pricing beforehand, right? Or the next one would be the latest by the time the tax return is lodged, right? As Adriana has mentioned earlier on the tax returns form, where some jurisdictions will need to disclose the related party transaction figures, and sometimes also the methods and the level of detail that you use to test the arm's length nature of your transaction. So this means that taxpayers would have to prepare the TB documentation beforehand, because you have to prepare it, then only you are able to actually disclose these information.
Thank you. And before we pass it on to Henry to give us his insight on China and Hong Kong, maybe if you could tell us what are some of the benefits of preparing and maintaining TP documentation?
Sure. I would say that, of course, it give you the answer before you actually go for the transaction, because sometimes it's very difficult to address, to make transfer pricing adjustment after the year end, when all the financial results are already there. At the same time, I would also highlight the importance of transfer pricing documentation to minimize the penalty that could be imposed by the tax authority. I think most tax authorities, they will have some guidelines to make reference to the penalty amount, and definitely whether a valid transfer pricing documentation is in place is definitely one of the important factors. By here, I'm not just talking about administrative penalty. I'm talking about the penalty that comes from the transfer pricing adjustment. So remember that if there is a double taxation agreement in case, there could be tax credit available arising from the transfer pricing adjustment. However, no tax credit will be available from the penalty arising from the transfer pricing adjustment. So that will be an extra cost to the taxpayers. So make sure that you have the proper transfer pricing documentation in place so that to minimize the chance of the penalty.
Any other further thoughts, Hon Chuan, on these penalties?
I guess what Henry has mentioned, I think, for us, apart from TP documentation being a compliance document, I mean, what Henry has mentioned is reduce your TP exposures, actually builds confidence for the tax authorities to show that you have made reasonable effort to actually prepare and maintain the TP documentation. Penalty protection. I think lastly would be, I think, on the part where we're talking about the planning tool, and taxpayers has already invested in getting the TP documentation prepared, right? Another thing is crucial for taxpayers to maximize the benefits of using this TP documentation as a planning tool, right? So you have already paid for TP documentation. Why not use it as a planning tool to assess risk areas in the group and plan for the group's global TP framework and policy at the same time?
Thank you, Hong Chun. So Henry, maybe if you could give us a brief overview of how is the transfer pricing framework in China and Hong Kong, given that is fairly, especially in Hong Kong, fairly new, but I pass it on to you.
Yeah, thank you, Joanna. I think, of course, I'm going to talk about a little bit more about how is this transfer pricing law in Hong Kong and China. First of all, I will just briefly go through the threshold for preparing the transfer pricing documentation. I think for country by country report, it should be quite universal, right? Across the global. So I will not mention that in this slide. But for master file and local file, I think each jurisdiction has its own set of threshold. And in Hong Kong and China, somehow it's relatively complex. So here you can see that for the threshold of Hong Kong, for master file and local file. In Hong Kong, the threshold is the same for master file and local file, while in China, the threshold is different. So I'm talk about Hong Kong first. You can see that there are two tables here. So you only have to do the master and local file when you fulfill the requirements in the both tables. In the above tables is about the Hong Kong company size, while in the bottom table is about the related party transaction. Remember that you don't have to fulfill all the items in order to fulfill the requirement, because you can see that in the above table is 2 out of 3, while in the below table, in the bottom table is 1 out of 4. So, so just to give you a brief introduction, you can compare it with your the financial performance of your own company to see whether a transfer pricing documentation must be in place in Hong Kong. Of course, even though you are not there yet, it doesn't mean that transfer pricing does not affect you, because we can also see that the tax authorities are also looking to ask for questions, request for benchmarking reports, even for those that does not exceed the threshold. So they may still impose transfer pricing adjustment to you. Next. Okay, so how about China? Actually, in China, only those big corporations have to do the master file. So it's unlike Hong Kong. So you can see that if so that's why many corporations in China they are only required to do the local file, but not the master file. As you can see, this is about the master file threshold in China. So you can see that the related party transaction threshold RMB 1 billion, which is quite a big amount. So, so most probably, if you are setting a group between Hong Kong and China, most probably you have to prepare master file in Hong Kong rather than in China. But anyway, a master file should serve the whole group. So that's why you still have to prepare for that. How about the local file? Maybe in this, the next slide. Yeah. For local file requirement in China, you may see similar figures than that in Hong Kong, because I suppose the Hong Kong government is actually copying the threshold in China for local file. You can see that there's similar figure, but just a little bit different because of the exchange rate between Hong Kong dollars and renminbi. But the figures is actually almost the same if you take into account the exchange rate difference. Of course, I think most of the most of the taxpayer are doing the first type of related party transactions, which is the buys, the sales, and purchase of goods. Yeah, which is the most common type of related party transaction, which is the first item here. So you can see that the threshold is RMB 200 million. So you may, if you want to take one figure out from this seminar, I will take this figure. If you have to remember whether you have to do master file and local file in Hong Kong and China. So next. Okay, after talking about the threshold, let me share a little bit of how transfer pricing will affect you in China and Hong Kong as well. I think some of you may know that in China, there could be a two form of setting up in China. One of them is, of course, a subsidiary, which we usually call the WOFE, while another one is the representative office, which we call the RO. Of course, they are a little bit different because for RO, they are not supposed to derive income in China. It can only be a back office. So that could, I would say this will be the cost center rather than a profit center. If you really want to do a business and earn some income in China, you have to set up a subsidiary. So how about, other than that, how about from the transfer pricing perspective, what is the difference? You can see from the two web boxes. For RO, there will be, even though there is no income, there will be a deemed profit. The ratio will be 15%, which is quite universal. So in short term, the profit margin of the RO will be 15%. So how about the WOFE? Of course, for WOFE, you will have a separate set of accounting records. So that's why the profit ratio will follow the benchmarking results, which is by comparing with other entities doing similar nature of work. So, when you decide whether you want to set up a WOFE or RO in China, for tax consideration, you may judge if your entity in China is only doing simple work. For example, the call center or the or administrative center, rather than doing if they're just doing simple work, most probably they only deserve a low profit margin. So it may be better if you set up a WOFE rather than RO, because for RO the profit margin will be fixed at 15%, while for WOFE it could be 3 to 5% if you are really doing some simple work. However, if you are doing some more variable work like R&D or self-center or whatever, then of course, from transfer pricing perspective, they deserve more, usually deserve higher profit. So that's why if it deserve a higher profit, it could be similar to 15%. So from tax perspective, either you set up a WOFE or RO doesn't make a difference. So it really depends on your work. If you do simple work, I would still, even though it's a back office center, I would still prefer to set up a WOFE from transfer pricing perspective. Of course, there are many other considerations, but the transfer pricing is definitely one of the important considerations that you will have. Next. In the beginning, I talked about the domestic exemption in Hong Kong and China, but also I also highlight that because in Hong Kong and China, we usually offer a low tax rate for some special industries. So most of them in the law, they have been written in the law that if you want to enjoy the low tax rate, your transactions with the related party have to fulfill the arm's length principle. So that's been written in the law as a requirement to enjoy a low tax rate in Hong Kong and China. So in this slide, I just want to highlight a few industries that can enjoy a low tax rate while there is supposed to be quite a number of related party transactions with other entities, group entities which may not be able to enjoy the low tax rate. Yeah, so in China, I think many of you know that there's a 15% tax rate as compared to the 25% normal tax rate for high and new tech enterprise. So I think it's not that difficult if you have carried out some R&D function in China, but certainly you may want to separate different entities so that only those and put all the R&D personnel into one entity in order to increase the chance to enjoy the 15% lower tax rate. Another tax benefit that you can enjoy is, of course, in Qinghai and Guangdong. Yeah, of course, in these two cases, if there are some, if you are qualifying enterprise, you can also enjoy the 15% tax rate. So, of course, these two, so the entities there may enter into transaction with enterprise in other cities in China. So in that case, you still have to fulfill arm's length principle. How about in Hong Kong? I just want to highlight some special industry. There's not all exclusive. First of all, the corporate treasury center, there will be half tax rate if you fulfill certain requirements, and of course there will be a lot of interest transaction between this entity as other entities. So make sure that they have fulfilled the arm's length principle, and at the same time for carry interest, we are now offering 0% tax rate. So of course, the tax authorities will always look for whether it fulfills the market price for the carry interest. This is especially important for the asset managers in Hong Kong. And another one would be about the shipping industry. So I cannot go through it in detail, but please be aware that if you are enjoying a low tax rate in Hong Kong and China, transfer pricing it does matter to you. Yeah. So how about you, Angelina? I think we'll go on to the next section. Yeah.
Yes, thank you, Henry. So I think it's very similar, the Hong Kong aspect, to Singapore as well, where, for example, if you are under an incentive, and I think Hon Chan can also verify this on Malaysia, transfer pricing will apply to you as well. So similar industries, shipping, asset management, global exporters, mainly because you will have some conglomerate of entities with zero tax rate versus higher tax rate. And I believe Malaysia is similar, right?
Yeah, that's the same. To invite foreign investment, Malaysia has tax incentives on manufacturers, R&D, green technology, you name it.
Yeah. Okay, so with that, let's move to or not last sessions, but the most exciting part, I think, which is the case study, which basically we put here some thoughts on the typical structure that some of the companies will be dealing with, and some of the most common transactions. And also we choose this industry because I think this is the industry that has bring the biggest challenges after the base erosion and profit shifting initiative, because the digital economy is one of the industries that have a lot of issues to basically delineate the point of how to allocate profit. So let's think about this case study where we have a company or the group develops software as a service products for business processes. It does B2B sales, and we have a head office, company A, located in France, that has an strategic and C-suite roles, research and development for global products and new products for Europe. And company A has two sets of presence in Asia, one which is company B with a regional head office in Singapore that also does some level of R&D for Asia market, excluding China, and sales in Asia for where there is no entity presence, excluding China. So you can have a sales entity located in maybe India or Indonesia or Thailand, excluding China. You may have a product engineering in India and a global back office in Philippines. Then we have company C, that is a holding company located in Hong Kong and holds the China operations, with maybe a sales entity in China and a product engineering in China. So the question is, what type of transactions would you typically find in these structures, and what are the challenges that the taxpayers will face with this type of structures? So obviously, one of the key things that come into mind is the possibility or the opportunity as well of having management fees. And the reason we always bring the management fees aspect is because, in my experience, and Hon Chan and Henry can say their view, the definition of what is deductible as management fee and what is acceptable as chargeable management fee differs substantially from country to country in Asia. I think in Asia, management fees has already the bad reputation from being perceived by tax authorities as an attempt for a profit shifting or transfer profit to the service provider from the service recipient. Hence the reason why it can be quite troublesome to gain deductions. So for example, if we were talking from Singapore company B and company A trying to put some management fees in the form of strategic or general branding or general finance on a global and a regional level, and you try to push down to the sales entity in India or in Thailand and to the project engineer in India or to the back office, you will always have a few issues. One is whether there is duplication, if it's coming management fees from company A and company B. Two, whether there is a necessity of those services if you have a similar team in the respective countries. You will also have a lot of issues around whether there is a real benefit and how you prove the commercial benefit. And we have extensive discussions with our clients on this, whether you really need to go to the extent on having interviews with operations to really understand what is it that they do on a day-to-day basis for the benefit of these entities. So I know a lot of people think a lot about the markup, the cost base, and the allocation, but I think nowadays the most challenging aspect to prove is the benefit test, because the allocation and the markup is measures that you can prove with values and with a mechanism and with a process, but proving the benefit is something that first of all, most transfer pricing guidance doesn't say specifically what is it that the tax authority expects for to prove the benefit. And two, it can be quite subjective. And three, a lot of subsidiaries tend to not see the benefit of being part of a group. So challenging aspects of management fees. I would be keen of hearing from Hongchuan and Henry their view on this, and how, for example, let's start with from Hong Kong and China point of view. Henry, what is your experience? If we have some management fees coming down, say from company B or company A to the sales entity in China or the product engineering entity.
Yeah, regarding the management fee, I would say that Hong Kong is relatively more lenient, while in China, I would say it would be fairly difficult to claim tax deduction on the headquarter management fees. In Hong Kong, I think it's just we are more lenient. I think as long as you have a proper basis of calculation, which is usually, I think, is the cost plus basis for management fees. And at the same time, because maybe for company A or for company B, and not only serving the Hong Kong entity, where they are serving the whole group, so they will also concern whether the reasonable apportionment basis have been adopted to allocate the portion of fees to the Hong Kong entity. So as long as we can show that there is a benefit, I think in Hong Kong the problem is less. While in China, I would say that in most circumstances, they will not allow a tax deduction for management fees from the headquarters. So be aware of that. So if you really want to do it, definitely I think you have to identify a more specific nature of the service provided by the headquarters. For example, design fee or commission or whatever. You have to be more specific to show that there's a real benefit of it. Other than that, you may have to show that without this management function, the China entity cannot survive. So for example, if you assign some salary of the finance people in Singapore or in France that they help doing the maybe the consolidation. In that case, the tax authorities will challenge whether they are already local finance people in China. If that is the case, it's not likely that they will allow the management fee deduction because they would think that it brings no benefit to the Chinese entities. So how about you in Malaysia? How about you, Hamu?
Well, I do agree what you have said regarding management fee. And my point of view is why not think about thinking of another term for management fee, since every tax authority, when they hear management fee, they will be skeptical on what consists or what comprise management fee, right? Because based on my experience, I've seen a lot of taxpayers, they group a lot of services together and treat it as management fee. Why not term them separately? Like, for example, if you provide marketing services or strategic management services or support services management, why not term them as support services? And then from there, based on the tax authority's point of view, they'll understand more on what the actual services is instead of naming it management fee. Then tax authorities would have that additional uphand to tell you what is management fee. Can you please provide me evidence on the benefit received from the recipient point of view, right? So these are the things that we have faced during the audit.
Yeah, so another aspect, so I think a second common transaction is also intragroup funding and intragroup loans, which can happen within the group. I think loans have another set of challenges because the first thing, obviously, when an intragroup loan is being set up, you kind of want to optimize and get some benefit out of going down that path. And I think nowadays, some of the issues with loans and funding relates first to the fact that you really need to make sure that the contract that you set up for the loan is in substance a loan, as it doesn't have any clauses that are related to equity in nature. So very open clauses like I will lend you 10 million, but you pay me whenever you feel like it, and there is no condition or penalty for not payment. That leaves a lot of open questions on whether the loan is equity or loan in nature. I think there is another aspect here as well, where you have to think about the interest deductions rules from tax point of view. And then once you have that iron out, then you can look at the TP aspect on what interest rate is the appropriate market interest rate. And that's generally how, especially from Singapore point of view, when you are extending loans from the subsidiaries, it's always about defending the interest rate and the deduction from the subsidiaries point of view. But I would be happy for Henry also to give some views on China and Hong Kong and Hong Kong and on Malaysia.
Yeah, thank you. So in Hong Kong, yeah, I agree that we have to first look at the tax deduction and the withholding tax issue. In Hong Kong, please note that if normally, I think in most circumstances, for a Hong Kong company that is paying interest to a non-Hong Kong group company, in most cases, is not deductible in Hong Kong. So please be aware of that. So you make sure that you know that. So that is go beyond the transfer pricing. At the same time, of course, Hong Kong has no withholding tax on interest. So yeah, as well. So in China, I think is somehow quite different. In China, of course, it also allows tax deduction on for those paid to the non-China entities. But there will be a thin capitalization rule. So there is a limit of the tax deduction that you can claim. At the same time, is a withholding tax. on interest or in China, in generally 10% and could be reduced to 7% in some DTA arrangements. At the same time, I would also want to highlight that because there is a foreign exchange control in China, to make sure there is a limit of the foreign debt that each China entity can borrow. To make sure that you register properly for any foreign debt, because you have to be registered for it from the authorities. If you didn't do so, you may not be able to pay any interest out, and not to mention any tax. Yeah, so please be aware of that. So how about Hong Kong in Malaysia?
Yeah, financial transactions is actually increasingly scrutinized by the Malaysian tax authorities. Previously, they may not have the expertise to actually go through a test the intercompany loans transactions. But now they are well aware of the importance of financial transactions. And recently, they also have introduced the earnings stripping rules to actually impose interest deduction limitations on all the intercompany financial transactions. So that bear in mind that we will need to reassess on the intragroup loans for Malaysia.
I think last will be royalties, which obviously when there is ownership of software, the first thing that comes to mind is obviously creation of intangibles, which is what has we save the more complex for the end, in the sense that the royalties is always a complex issue nowadays, because it's not only about just putting a royalty rate to charge from the legal owner of some IP or some trademark that has been registered, and that's about it. Actually, in today's world, this is probably the transaction that has changed the most, mainly because the first thing that you have to really make sure that you have very good clarity is who is the economic owner and the legal owner. So for example, in this structure, let's assume that company C, who is a holding and maybe doesn't have a lot of strategic and doesn't have any strategic and C-suite roles. If company C was trying to charge a royalty to company B, and then company B here, the regional head office, partly owning some level of IP and then push it down to these entities, I think we will have a real problem, because in Singapore and in Southeast Asia in general, for you to be able to have some basis to pay royalties, it has to be under the assumption that you're paying to the legal and economic owner of the IP, and that legal and economic ownership can only be claimed if the company that is claiming the ownership performs some key functions in developing that IP, in maintaining that IP, in making sure that that IP is economically valuable over a certain period of time, which is also called as the DEMPE functions. So I think that is generally the most challenging aspect before even starting to talk about a royalty rate and what is the basis of that royalty rate. How about you, Henry and Hong-Chan, your views on this aspect?
Yes, definitely agree that nowadays for royalty arrangement, we don't just look at the legal owner of the IP. We will also look at who contributes to the value creation process, which usually called the MP function in IP. So basically, I think that there's similar laws in Hong Kong and China. In Hong Kong, we have just had it last year that are about the MP function. So, but anyway, I think in reality, if you're not paying the royalty to some low tax jurisdiction or the offshore jurisdiction, that we most probably I think normally the Hong Kong tax authority will still accept it, as long as, of course, you have the transfer pricing benchmarking in place to show that it's arm's length. But we've been reminded that it's a withholding tax on royalties paying out of Hong Kong. In Hong Kong, we normally don't have the withholding tax for dividend, for interest, for service, or for trading. But we do have withholding tax for royalties. So be reminded to file a tax return if you have paid out royalties out of Hong Kong. So in China, I think it's pretty much similar. But I also want to highlight one point that your royalty arrangement have to be in place in the first maybe 1 or 2 years of operations in China. Because if the tax authority can see that, okay, maybe in the first few years, you don't have the royalty arrangement in place, you are still doing business in China. If you start the royalty arrangement maybe a few years later, they may think that, okay, whether it is necessary to have the royalty arrangement, whether the IP is that important to the Chinese entities if you don't have it in place in the beginning already. So make sure that you already think of the royalty arrangement at the beginning of your operations in China. Yeah. So about Hong Kong in Malaysia?
Yeah, I guess every jurisdictions are trying to grab their share of intangibles or IP royalties, right? They will have their own local royalties definition. Traditionally, these royalties are based on product development, technology. But in Malaysia, we have also included like marketing intangibles or even government grants provided to the taxpayers, which normally a independent party may not be able to obtain these government grants. So these may need to be remunerated through royalties. It's very similar to the China's DMPay, where they included the promotion at the end, DMPEP promotion, where you're talking about marketing, and China have that location savings as well. So I guess royalties wise, it'd be good to look at the local intangible rules to make sure that some of the intangibles do not fall in place within your royalty destination.
That's good. So maybe we can summarize what are some of the common disputes and that we have spoken about, so people can take away a few points, and maybe what are the key be ready audit tips, and then we can open for questions. So I think some key points that maybe is good that people take away from this session. One is obviously in nowadays structures and transactions need to have some commercial substance, and that means that we are now into a point that not a control transaction can be only planned because of tax motive purposes. There has to be a balance between obviously doing tax planning, but also having some commercial reasons behind it. So in today's world, basically what we see more and more is just challenging the typical PO box and patent box arrangements. And within that, obviously, it's important to have a proper characterization, a proper substance, and a proper contract that matches that substance. The second point is obviously the fact that you can be challenged on the basis that your pricing is incorrect or have been implemented incorrectly. For that, obviously, the best support mechanism is to have some level of benchmarking and comparability analysis, whether it is with internal data or external data, to make sure that you have some market price that can substantiate your price or your margin. Third point that is always, I will say, that is kind of like the most likelihood scenario of having a tax audit is situations of recurring losses or big fluctuations in profit results. So for example, if you have 2-3 years of losses in a combination of high value related party transactions, the chances are that the tax authority will try to review and audit you, because in their view, it's like, if a company is a recurring loss maker, then why do they remain in business if they're not making any money, especially if they're part of a group? The choices of comparable companies is always a challenging one, especially in Asia because a lot of tax authorities prefer to have local comparables, which makes it very hard to follow sometimes the practice of regional comparables. Nevertheless, for example, Singapore, and Henry can comment on this, and Hong Kong will probably be a little bit more lenient, whereas places like Malaysia will be more strict, or Thailand. And then the last point is the fact that we have different interpretations, or we could have certain interpretations of what it is the arm's length range. In majority of the countries, the arm's length range is the interquartile range. We have certain countries like India, I will say, is one of the exceptions, where you have a narrower range where the point should be the 35th to the 75th percentile. So maybe with that, I pass it on to Hon Chuan Tan to discuss a couple of final disputes points and maybe some audit environment being ready.
Yeah, I'll just quickly briefly go through this. Well, the first one is TP adjustments, right? So it's generally allowed and performed before closing the books, but we need to be cautious about your indirect tax, custom issues, especially when physical products are involved. And I also need to highlight that retrospective adjustments can be very challenging and may have double taxation issues, so bear that in mind. Another common one is the use of secret comparables by the tax authorities, where they have their own set of range of results obviously would be favorable to the tax authorities. So that's a dispute that we need to deal with the tax authorities. Services, one of the most commonly scrutinized area by the tax authorities, where there are challenges, as we mentioned earlier, on the benefit test, chargeability of services and costs. And I would like to emphasize this, that taxpayers generally test the markup of services, but they don't assess the cost base, which is very equally important to ensure the correct fee is actually charged, right? For distributors that's similar to the recurrent loss makers, over 3 to 5 years, and as well as the dispute on your pricing and operating margin, an independent entity will not have been operating for a long period of losses. Loans, we have the debt versus equity issue, interest-free loans as well. Some jurisdictions have imposed interest deductions limitation, for example, tin capitalization rules in Australia, or the earnings stripping rules, which is in line with the OECD. And of course, the withholding tax rules on interest rates. And lastly, now that we are in the era of digital economy, right, we faced common disputes on intangibles, IP definitions, right? Centralized IP ownership versus co-ownership of IPs. And lastly, the acceptance of centralized revenue centers.
Thank you, Hon Chuan. So I think we have a couple of slides on the audit environment, but I want to just say here that tax authorities today do understand TP. They are very trained and well trained now, so they are ready to ask technical questions and making sure that there is no tax leakages. Some countries, tax authorities may have even tax income targets, and I think it's good to understand the high level of activity in the context of the fact that when you do your tax return, you're not going to get your audit the next month. You may get it even up to 5 or 7 years, because the tax authorities have a statutory period in which they can investigate, and as long as those years are open, then you can be asked by the tax authority about your arrangement. So usually the audit doesn't come next month after the tax return. It may come 2 or 3 years down the track. And before we pass it to Henry to give the final remarks, so Hon Chuan, if you were a tax manager of a company or a TP manager, what would you have ready to for an audit?
Yeah, nowadays the most common document, apart from your usual TP documentation, are the contracts, which plays increased importance in an audit, right? We would like to emphasize that it's good to have contracts in place. At the same time, the substance within the contract will need to reflect what has been documented down in TP documentation, as well as your TP policies as well, so that when doing an audit, there are no inconsistency or discrepancies between the documents. Apart from that, I think other common informations that most companies requested are invoices of your organizational charts, your job descriptions for your, for tax authorities to review or interview your personnel, and obviously the work papers behind the price calculations.
Thank you, Hunchan. And Henry, before we answer a few questions, so if people have some questions, please post them now. We will start answering after Henry. So Henry, what are your final remarks on being audit ready?
Yeah, I would say that in China, definitely, I think another point that I want to highlight is that it is generally a way to solve a permanent establishment problem, which is PE, right? While especially during COVID, I'm aware that many Hong Kong corporations they send their staff to work permanently in China to work, which will create the PE problem in China. And definitely, when you want to when there's an audit, the ultimate way is to use a TP method, the transfer pricing method, to allocate a reasonable amount of profit to China. So make sure that you are aware of your PE issue. At the same time, make sure that because for some companies, they used to just set up a back office center or a manufacturer in China, but now they are go beyond that. They have the accounting function, they have the sales function also in China as well. So if you still use the manufacturer to compare with the profit margin with your own entities, but you are actually doing much more than that, so there will be a high risk that the Chinese tax authorities will not accept the benchmarking result, and will ask you to pay much more profit, much more tax in China. So, and on the other hand, I think everyone here knows that Hong Kong is an international financial center. So IPO is active in Hong Kong. So if you want to go for IPO, transfer pricing is definitely one of the questions that you will face if you want to prepare for that. I can see that many corporations, they have to pay huge amount of tax and penalty when they want to go for IPO listing. So make sure that you prepare well for that, so that you minimize the chance of penalty. And at the same time, field audit and investigation has been very active in Hong Kong at this moment. I can foresee that the cases are triple or even 4 to 5 times than the last few years. So, and usually transfer pricing is one of the ways to solve the issue when you face the field audit or investigation from the Hong Kong tax authorities as a settlement basis. So with that in mind, maybe we will go on to answer the questions from the floor. Yeah.
Yes. So we have a few interesting questions. So the first one is, let me just answer it live. A Hong Kong company met the criteria in the year 2020 and prepared its master file and local file for the year. However, it does not meet any criteria for the following year in 2021. Is the Hong Kong company required to prepare documentation for the year 2021?
Well, I would say the mandatory. The answer could be no. You may not be required to do it. But in practice, I would say that if 2021 is just an exceptional year, and you will fulfill the threshold in 2002 or 22 and in the future, normally the tax authority will still ask for the TP documentation for 2021, because if it's just a one-off job in revenue, for example, because of COVID. So if you foresee, in short, if you foresee that your revenue or you will pick up and then the threshold will be reached again in the future, I would suggest that you still prepare the 2021 master file and local file as well.
Thank you, Henry. So we have another question, which I think is a very good one. Generally, where there are cost plus charges between Hong Kong HQ, and subsidiary and a branch, what is the TP overview in Asia Pacific? So I think maybe one point here, and is that if we are referring to cost plus charges, I'm assuming we're talking about management fees between the HQ and subsidiaries and branches. I think the general overview for best practices, which we mentioned during the case study, is that the starting point has to be very detailed on what is the type of services, how you make sure that those services are considered chargeable from each of the service recipients, and that there is an economic benefit. And once you have ironed out that, then you can go into the detail of how you are going to determine that service charge. Hon Chan or Henry, do you have a point here?
Yeah, I was going to add on to say that similarly, when there are cross charges, I think one of the more important queries that were asked by the tax authorities are whether they are duplicative, right? So in your TP documentation, you really need to emphasize and document down that each services provided by each entity are different and would have benefit the respective recipients.
Yeah, well, in Hong Kong, I would say that the ILD, of course, it's just for general management service. The tax authorities has mentioned that the markup should not exceed 12.5%. Yeah, in its guidance. While in China, first of all, as I mentioned, management fee to headquarters is generally not deductible. While in case it's deductible, I think you have to look for specific situation to do the benchmarking results. There's no specific guidelines on that.
Yeah. I think one more point that I overlook is the fact that you need to have a contract. So the contract is very important as well, because it's the first document asked by the tax authority. There is a last question here, which is, are there any safe harbor rules in China, Hong Kong, Singapore, or Malaysia? So I'm assuming this person is referring to when mandatory documentation is there and when it's not. I can reply on the Singapore part that taxpayers with revenue greater than 10 million SGD are within the mandatory TP documentation territory. Then they have to look at the specific transaction to see if the transaction is exempted or not. Hon Chan, you want to talk about Malaysia and then Henry?
Yeah, in Malaysia, regardless of as long as you have control transactions, you would have to prepare, but they have they have a threshold for full and simplified TP documentation, and the threshold is you have Ringgit Malaysia of 25 million worth of revenue and 15 million worth of related party transactions, or if you have 50 million Ringgit Malaysia, 50 million worth of intercompany loans, then you have to have a separate TP documentation to test your loans transactions.
But if you are below that, then you have the simplified TP documentation. So in Malaysia, regardless, you still have to prepare either a simplified or a full TP doc, right?
Yeah.
Well, for I think in Hong Kong, China, I think I've mentioned that in the previous slides on the threshold for master file and local file. Maybe I will add on more on country by country reports, which I think applies to almost all the countries, right? So as long as your consolidated revenue of the whole group exceeds, I think 750 million euro, right? Of course, you have to be transferred to the local currency. Yeah, but it's usually is the 750 euros. million euros, then you have to do the country by country report in your own I think in every operating countries that you have. So in Hong Kong, you have a portal to do it. In China, I think is somehow maybe because of COVID, they have not enforced it to every taxpayer. But in Hong Kong, you have to do it, not just prepare it, but you have to submit it on time in Hong Kong. So make sure that you are aware whether you have to do the country by country report as well.
Thank you. And I think with that, the questions, there is no further questions, but if you want to reach to us, we have our details in the slides, which we will be sending with the recording. You can reach us here for our Singapore, Australia, and Malaysia. We have a lot of social media channels, and we're always organizing webinars once a month. We have a lot of good content as well in our YouTube channel, which we share with all our viewers. And we also have, obviously, let me just go back to the first slide, and we have here Henry details. So if you want to reach out to any of them, any of us, feel free to take our details from here as well. I think that is the end of our webinar. Thank you everyone for attending today, and thank you Henry, thank you Hon Chun, for giving us some very good insights.
Thank you.
Thank you very much. Yeah, for all the participants as well as Hong Chun and Angelina. Yeah.
Okay. Thank you. Okay.
So thank you all.
Have a good rest
See
of the
you.
afternoon.
Yeah.
Bye.
See you all.
Thanks, guys.
Bye.